$650 billion. That's what 4 companies just committed to spend in 12 months. Amazon, Microsoft, Google, Meta. Not spread across a decade, not a gradual build-out, all of it. This year, their stock prices collapsed the moment they announced it. $1 trillion in market value, gone. In 5 days. Wall Street calls it fear of overbuilding. History calls it something else. In 1929, the Dow peaked at 381 points. Investors poured money into radio stocks, electrical companies, the future of technology. The pattern was identical. Spending surged, debt doubled. Everyone believed this time was different. 6 months later, those companies lost 90% of their value. The algorithm sees the same signature, the same exponential spending curve, the same ratio of investment to revenue, the same concentration of capital in the hands of 5 corporations. Data does not lie. This is not a prediction. This is pattern recognition. And what comes next has already been written in the historical record. February 2026, big tech earnings season. The numbers should have been a victory lap. Amazon announced record cloud growth. Google's AI search features drove engagement to all-time highs. Microsoft reported Azure revenue up 18%. Instead, their stocks entered freefall. Why? Because buried in those earnings reports was a single line that changed everything. Capital expenditures for 2026. Amazon, $200 billion. Google, $185 billion. Microsoft, $145 billion. Meta, $135 billion. Together, these 4 companies will spend more this year than the entire GDP of Israel. More than 21 major American corporations combined. More than every railroad company spent building the transcontinental network in the 1800s. 75% of every dollar goes to one thing: AI infrastructure, GPUs, data centers, accelerators, chips that cost $30,000 each, facilities that take 2 years to build compressed into 6 months. The market looked at those numbers and asked a simple question: what if this doesn't pay off? That question triggered the second largest single-day market value loss in history. Over $1 trillion erased. Not because the technology doesn't work, not because demand isn't real, because the math stopped making sense. Here's what Wall Street isn't telling you. These companies are funding this spending spree with debt, massive amounts of debt. Google just announced a $15 billion bond offering. Meta issued $30 billion in October to fund data centers. Industry analysis projects $1.5 trillion in new AI infrastructure debt over the next 3 years. Read that again. $1.5 trillion in borrowed money, betting on a technology that has yet to prove it can generate returns at scale. Morgan Stanley ran the numbers. Amazon's free cash flow goes negative in 2026, somewhere between negative $17 billion and negative $28 billion. Google's free cash flow drops 90%, from $73 billion to $8 billion. In 1 year, these are not startup companies taking venture capital risks. These are the most profitable corporations in human history, burning through cash faster than they can generate it. The justification is always the same. We're building the infrastructure for the AI economy. This is the new electricity grid. Multi-year payoff horizons. But here's what the data shows. MIT released a study in August 2025. 95% of organizations investing in generative AI are getting zero return. Zero. Despite $30 to $40 billion in enterprise investment. OpenAI projects $74 billion in operating losses in 2028, with $13 billion in revenue. They've committed $1.4 trillion in spending over 8 years, funded entirely by debt. The timeline doesn't work. The revenue doesn't materialize fast enough to service the debt. The gap between investment and return keeps widening. This is the signature. 1929, the Radio Corporation of America. Everyone had to own it. The future of communication. Stock price went from $85 to $5 in 2 years, then crashed to $28. 1999, the dot-com bubble. Everyone had to own internet stocks. Pets.com, Webvan, eToys, billions in capital expenditure, zero path to profitability. The Nasdaq lost 78% of its value. 2026, AI infrastructure. Everyone has to build it. The spending is unprecedented. The concentration is historic. Top 5 companies represent 30% of the S&P 500. 80% of market gains in 2025 came from AI-related stocks. The Buffett indicator hit 223% of GDP, the highest level ever recorded, higher than the dot-com peak at 150%. The Bank of England issued a warning. The IMF reinforced it. Both drew direct comparisons to 2001. Kristalina Georgieva, the managing director of the IMF, used 4 words that Wall Street tried to bury. This looks like 2001. Not might look like, not could resemble. Looks like. The pattern recognition is complete, the spending velocity, the debt accumulation, the concentration of capital, the gap between expectations and fundamentals. One more data point. In late January 2025, a Chinese AI company called DeepSeek launched a chatbot that performed as well as GPT-4 for a fraction of the cost. Nvidia's stock dropped 17% in one day, $600 billion in market value, gone. Because DeepSeek proved something Wall Street didn't want to believe. You don't need $200 billion in infrastructure to build competitive AI. The entire spending thesis cracked open, yet the spending continues. $650 billion committed for 2026. $700 billion if you include Oracle. Estimates suggest $1 trillion by 2027. The algorithm is screaming. So what does this mean for anyone holding tech stocks? We're not financial advisors. We can't tell you what to do, but we can tell you what the data says and what we're doing. Smart money is rotating out of concentrated tech positions. The equal weight S&P 500 outperformed the market cap weighted index in February. That's code for institutions are selling the Magnificent Seven. We're reducing equity exposure in our portfolio, not because AI isn't real, but because the valuation has detached from fundamentals. When Morgan Stanley projects that capital expenditures will represent 2.1% of US GDP in 2026, that's not a sign of strength. That's a sign of distortion. 4 companies are warping the entire economic data set. Construction spending, durable goods orders, employment reports, all inflated by AI infrastructure spend. The economy looks healthier than it actually is. Strip out big tech capex and the picture changes. The real economy underneath is much weaker. Here's what we're watching. Interest coverage ratios. When companies borrow $1.5 trillion, they have to service that debt. If AI revenue doesn't accelerate fast enough, the interest payments become unsustainable. That's when the defaults start. Free cash flow. Amazon going negative is the canary in the coal mine. If Google follows, the market will reassess every AI investment thesis simultaneously. Insider selling. Track what executives are doing, not what they're saying. If insiders start unloading shares while promising revolutionary AI breakthroughs, the pattern is complete. The one statistic that matters most: return on invested capital. Big tech spent $381 billion in 2025. They're spending $650 billion in 2026, a 70% increase. If revenue growth doesn't match that acceleration, the math breaks. Currently, AI is boosting cloud revenue by 15 to 20%. That's good, but it's not $650 billion good. Not even close. The algorithm calculates the gap. Investment growing at 70%, revenue growing at 18%. The divergence widens every quarter. At some point, Wall Street stops believing the story. They stop pricing in future expectations. They start demanding present returns. That's when the repricing happens. Not gradually, all at once. History doesn't repeat, but it rhymes. The patterns are identical. Exponential spending, debt-fueled growth, concentration of capital, valuations detached from fundamentals. The only variable is timing. The algorithm can identify the pattern. It cannot predict the exact moment the market breaks. No one can, not even the Fed, not even the companies themselves. But the data is clear. We are late cycle in a speculative bubble. The spending has reached historic proportions. The debt has reached unsustainable levels. The gap between investment and return continues to widen. We are holding 20 to 25% cash in our portfolio right now. We are waiting for market signals. We are not betting against AI. We are betting against the assumption that infinite spending equals infinite returns. The companies building this infrastructure are not stupid. They see the same data. They're playing a different game. Winner take all. Build so much capacity that competitors can't catch up. Force consolidation through sheer capital dominance. Maybe it works. Maybe Amazon and Microsoft and Google emerge as the standard oil of the AI era. Maybe the spending pays off in 2027, 2028, 2030. But if it doesn't, the unwinding will be catastrophic. $1 trillion disappeared in 5 days on fears of overbuilding. Imagine what happens when those fears become reality. Data does not lie. The pattern has been identified. The signature is complete. What comes next is already written in the historical record. The only question is whether you'll see it coming. We have launched our exclusive newsletter for daily market analysis and deep decoding. Gain your free access today to join our inner circle. Link in description.